All right. Hello, everyone. This is Daniel Neesmith and Shana Fossum here. We are going to be doing a presentation on required minimum distributions and what you can do with those and kind of how to minimize some of the tax impact on it. But we're going to give people just a couple more minutes that are getting on. We're expecting a pretty good group this morning. Hope everyone's okay. You should be able to see a chat box. And as we do the presentation, Shana will field any questions you have in our chat box. So feel free to ask any questions, say hello, whatever you'd like to do. So hope everybody's doing good this morning. And we'll give everyone just a couple more minutes before I get started here on the presentation. While we're waiting for everyone to sign on, I'm going to tell you about some upcoming events that we have coming up. So we were going to do a presentation at Props. It was a client bring a friend event August 17th, but due to COVID, we had a lot of people cancel. And it seems like COVID's kicking back up again. So we're going to do an online event. It's going to be September 9th. Now, this is something I think everyone would be interested in. September 9th is the new date, and it's going to be Retiring in Biden's America. Now, this is not a political discussion. We're simply going to be talking about what are the proposed changes, tax changes in particular, that may impact middle-class Americans. So there's some very significant proposals that are on the table for next year. So Retiring in Biden's America is going to cover that. That's going to be September 9th at 11:45 a.m. It's going to be online. You're going to get the opportunity to share the event, invite your friends. Pretty much everyone that I talk to is a little concerned about what the new tax changes may be. And there's some startling things that we're going to be discussing. They're looking at changing the estate tax and lowering it much lower, doing away with the ability to have a step up in cost basis, for example, on your real estate and capital gains changes for taxes. And so it really something you should be interested in because it may impact middle-class Americans. So Retiring in Biden's America is going to be a presentation we're going to do September 9th, 11:45 a.m. So mark your calendars for that, and it'll also be on our website. Also coming up September 23rd, we've had a lot of folks in the past tell us they'd like us to do more events for multi-generational planning, meaning for your kids, for your grandkids. So we're going to do a family financial workshop Thursday, September 23rd at 11:45 a.m. Now we're going to record this as well so you can share it with your kids, your grandkids, people that are younger, but it's going to talk about what they should be doing at their age. How can they prepare for retirement? And also, how do we minimize taxes when we transfer wealth from one generation to the next? So our presentation on Family Financial Workshop is going to be Thursday, September 23rd. Mark your calendar for that. So that'll be a very interesting event. And always keep in mind, anytime you refer someone to us, and thank you guys so much for sending us and trusting us with your friends and family. We've been getting a lot of referrals, and we always take care of them, and we're very appreciative when you send us referrals. But of course, we have a giveaway. So at the end of September, anyone that's referred us someone, whether or not they became a client or not, is irrelevant. Anytime you send us someone, you're entered into a drawing. This month, this quarter, it's going to be for a gift card. This is similar to Ticketmaster. It's called StubHub, and what it is it's a gift card for $100. And you can use it for sporting events. You can use it for concerts. Pretty much any activity like that will accept a StubHub gift card. So that's for anyone that sent us a client or a referral through the end of September. So the quarterly drawing for the third quarter, the drawing will be held in the end of September. So please keep that in mind. And so I think we're going to go ahead and get started with the presentation this morning. Okay. All right, so hopefully everyone can see this. Uh-oh, I've got to go back to the beginning, it looks like. Thought it would start at the beginning. Almost there. I don't know why it didn't start over there. Okay, so we're going to be talking about required minimum distributions. So as you know, when you turn 72 years old, now, the new rule is at age 72, you have to take out what's called the required minimum distributions from your IRAs or tax-deferred accounts, like 401ks, if they're still at your old employer, 403bs, 457s. So required minimum distributions are a fact of life. Most Americans save money in tax-deferred accounts. And what it means is if you haven't started pulling money out, you have to take out a minimum. The reason for that is they want you to pay taxes on the distributions. So we're going to talk about how those are taxed. Of course, none of this is an offer to sell you a product. These are our disclosures. We're fully licensed and we're fiduciary planners. So why does the IRS care? They really care about the tax deferred accounts because they want their tax dollars. You should care because it's your money, and few people understand how RMDs work, the math of it, and the implications for your income tax. And it really can be a startling thing. We call it a tax time bomb. Sometimes if you've deferred all your IRAs and you get into retirement, all of a sudden, even if you don't need the money, boom, you're paying a huge tax you weren't expecting. So we obviously want to help you mitigate that type of expense and tax. So there's a lot of things you can do with RMDs. You don't have to take the money out and spend it. If it's part of your income plan, of course, you would do so. But a lot of people don't need the money. And we're going to talk about some different things you can do with required minimum distributions if you don't need to spend the money. For example, you can set up a tax-free plan for your family. So you can create a legacy with your required minimum distributions through the form of life insurance. You can fund long-term care. So if you're concerned about the cost of long-term care going up, you can offset those costs by having some type of long-term care policy in place that will help reduce that risk and give you a way to pay for long-term care. And you can do that with your required minimum distributions. It leverages your money and gives you a lot bigger pool of money to protect you from that other than just your distribution. So what is an RMD? What is a required minimum distribution? So number one, it's the cost of the IRA and the tax deferral. It's the price you pay for having deferred that money. Unfortunately, some people, they defer their taxes into a higher bracket. I know a lot of folks who could have gone ahead and paid the tax up front, put the money into a Roth IRA, and not had to deal with the required minimum distribution. So for example, if your kids are working and they're piling money into a 401k, chances are in 20 years, when they take it out of that IRA or 401k, their taxes are going to be higher than if they just had paid the tax up front, put it into a tax-free Roth. So just an analogy, you can tax the seed and have the harvest be tax-free. That's what a Roth IRA is. You pay the tax on the seed money and the distributions of the harvest are all tax-free. Or you can pay taxes on the harvest. And that's what most Americans have done. They've deferred all their taxes and the harvest of that is all taxable. So the required minimum distribution age is 72. Whether or not you need the money or not, you have to start withdrawals by April 1st of the following year after turning age 72 because the IRS, of course, wants their taxes. You may or may not need it, but you have to take it anyway. If you forget to take it, there's a 50% tax penalty. Not a pleasant situation. So if you were going to just pay 15 or 20% tax on the distribution, should you forego taking it out, there is a 50% penalty on the amount of money you were supposed to take. So we take it very seriously when you become a client with us, we automatically look out into the future and put an event into our contact management system, which will remind us that you have to take required minimum distributions on your 72nd birthday, the April 1st of that year. So we're taking care of that for you and make sure that you have that in place. And that's something we do automatically when you become a client. So if that's you, don't worry, we've got you in our system. So how are they calculated? How are required minimum distributions calculated? Well, there's a table, uniform lifetime table. They're looking at your life expectancy. So over on the left, that used to be the chart that they used, the uniform table prior to 2022, starting with RMDs in 2022, the distribution table, age 72, the divisor, you divide your December 31st of your previous balance of all your IRAs added together, divide it by 27.4. So that comes out to about 3.7% of your IRA balances. So that's the table. Each year they want a little bit more of the money, so the divisor is bigger. By the time you get to age 90, you're looking at a 12.2%, 12.2 divisor. So that's a big chunk of the money that's having to come out, and they want it to be zero at the time of your death. They want you to have taken all the money out. So this is how they're calculated: the prior year-end value of all your retirement accounts. So you can add them all up. You might have 100,000 in one place, 100 in another, whatever. You add them all together, and they don't care where you take it from. You can pull it off from one account or each account individually, as long as it adds up to the total. Then you use the divisor that I just showed you. The first year, it's 27.4, and it has to be withdrawn by the end of the year after you turn age 72. The year in which you turn 72, you have to take out that money, and it's taxed as ordinary income. So always be aware, ordinary income typically is taxed higher than capital gains, at least currently under the current tax code. So if you had $1 million, for example, at age 72, if you had $1 million in your IRAs all added together, you have to divide that number by 27.4. And that means your required minimum distribution for the first year is $36,496. That gets added to your other incomes. So it can have a significant impact. So let's look at this. Where are our savings? Well, $35.4 trillion are in tax-deferred IRAs, 401k accounts, things of that nature. So there's a lot of money the government wants to get its hands on. I know that surprises you, right? There's $35 trillion that has never been taxed. So the way that breaks down is there's different asset classes that the money is saved in. If you look over to the far right, you can see where these IRA savings are. The bottom, the light blue, is IRAs. Those are self-directed IRAs. That happens typically when you set up your own IRA, or you retire from a company. You can roll your money into an IRA. If you're over 59 and a half, you can roll your money into an IRA. $12.6 trillion are in self-directed IRAs. $9.9 trillion are in defined contribution plans. Those are plans through an employer, like a 401k, like a 403b, a 457. Those are considered defined contribution plans, and 9.9 trillion of the 35 trillion in tax deferred assets are in those types of plans. Moving on up, a smaller percentage is in private sector defined benefit plans, and then so on from there. So most of the assets are either in 401ks or IRAs, and that's what they want to get their hands on with those required minimum distributions. So here's a startling fact. What if everyone was 72 at the same time? So there's $35 trillion right now in tax-deferred IRAs and all the other accounts that are tax-deferred. If you divide that by 27.4, which is the first divisor when you turn 72, it equals a taxable income of $1.2 trillion. And if that's in the 25% bracket, that's $5,300,684,000 in income taxes. So you can see why the IRS and the government is anxious to force people to start taking money out. The sad part is, even if we had that kind of income tax all at once, what $5 billion would fund the government for maybe a 3-week period or so? the amount of money that they require, the deficits that they run. So, but that's how the math works out on that. So let's look at a way the couple saves money over time. So this is conventional wisdom, right? You $19,000 per year you're able to put into IRA or put into IRAs. 401ks, you're allowed 19,000. IRAs, you can do 6,000 a year if you're under the age of 50. So if we assume you're in the 25% tax bracket and you save 19,000 for 30 years, that's $570,000 of contributions. If you earn 7% a year, you will have $1,700,000 in tax deferred accounts. So you will have saved taxes of around $425,000 by deferring those taxes, or so you think, until you start making the distributions. You actually save a lot more if you just save that in Roth IRA accounts. That's how the math works on that. So $35,000 a year. We're going to look at a couple when they have to start taking their required minimum distributions. If one Social Security benefit is $35,000 and the spousal benefit, the spouse is earning $17,000, that gets factored into the taxes. If you're getting $50,000 a year from a pension and then $22,000 from other incomes, before your required minimum distribution, that's $124,000. So that's in the 25% bracket. So with the IRAs that we talked about, you saved some taxes by deferring. And if we go back, you would have saved $425,000, but you have $1.7 million you have to take a required minimum distribution on. That first year required minimum distribution is $59,264. So your first year income, when you add in that required minimum distribution, is going to be $183,000 for this couple. That pushes them up into the 28% tax bracket. So that's what the tax time bomb is. Those required minimum distributions, the income from that gets added to all these other incomes, and then all of a sudden you're in a higher tax bracket. Probably this couple wouldn't need that kind of income, but they're forced to take it out. So there's some planning measures that we take. When a couple retires, when you're in a lower tax bracket at retirement, even if you don't need to take money out of your IRAs at that time, let's say you retire at age 60. Well, we got 12 years where we can do small Roth conversions and try to keep you out of those higher tax brackets by moving small amounts each year over to a Roth IRA, paying a lower bracket, paying a lower tax in order to do so. My belief is that today's taxes are lower than they're going to be in the future. We think your taxes today are on sale compared to what they're going to be probably even next year. So it makes sense to do tax planning to make sure we do Roth conversions and pay lower taxes if it's at all possible. Also makes sense in many cases not to take Social Security immediately, but to take the equivalent of that out of your IRAs and defer the Social Security, because always at least 15% of your Social Security is tax-free, and you get a higher benefit by deferring. So there's a lot of different strategies we can look at to help reduce your required minimum distributions. Once you turn 72, there's really not much you can do after that time. So let's say you're taking out required minimum distributions and you don't need the money, so you don't have to spend the money. You can reinvest it, of course. You can put it into a non-qualified brokerage account and invest it in the stock market. You can take the money and you can fund all kinds of different types of things. What you cannot do with the required minimum distribution is put that required minimum distribution into a Roth IRA. If you wanted to take money out and put it into a Roth after you're age 72, you have to take out the RMD plus extra to do a Roth conversion. You can't use the RMD to fund a Roth IRA. So let's talk about a few things that you can do other than investing in the market. Well, number one, you can create a legacy with your required minimum distributions. So there's a couple of different things that you can do. Obviously, there's different people that want to spend the money. The IRS wants to spend the tax dollars, or Congress does really, U.S. government. So we'd rather your beneficiaries get that money, right? Our family. You can create a legacy with your required minimum distributions. And that's very easy. If you qualify for life insurance at that age, you can fund a tax-free life insurance policy. The death benefit would be tax-free. So let me go here and give you an example. I'm going to skip ahead a few slides. There we go. This is what I want to show you. Here we go. So at age 72, if your required minimum distribution was $10,000, now this is on a standard issue, non-tobacco, age 72 female. So let's say she wanted to take her required minimum distribution, or part of it, let's say that was $10,000, and she put it into this type of guaranteed life insurance policy. Your principal, of course, is going to be protected. And also the premiums, if you put $10,000 a year in from year one, you'd have a $440,000 tax-free death benefit for your for your family, for your beneficiaries. If you look over to the far right, the death benefit from the first year is $440,000. So this one I have it funding through age 90. So if somebody lived from age 72 to age 90, they're going to get $440,000 tax-free instead of just spending the money or put it into a brokerage account. This is a tax-free death benefit. And you can fund that with your required minimum distributions. We have similar policies like to this one where that death benefit can be used for long-term care. That's called asset-based long-term care. We're big fans of those because you can use those types of policies and fund them with your RMDs. You can use them for at-home care. You can use them for assisted living. You can use them for nursing home care or a combination. And then whatever you don't spend is going to go to your family and a death benefit. If you never use it, you're going to get your money back plus interest. But this particular policy you're looking at is to maximize the tax-free death benefit. So you can fund a legacy with your required minimum distributions. So there's lots of things you can do with those RMDs to create a tax-free legacy. So in review, required minimum distributions happen at age 72, whether you want them or not. They get added to all the other sources of income that you have. And there are ways to reduce that required minimum distribution if you start planning early. So if you start at age 60, for example, you can take out small amounts each year, move it to a Roth, and then you reduce the required minimum distribution, and that Roth IRA is tax-free. By the way, your heirs of a Roth IRA, they're going to get that money tax-free as well. I will mention, since we're on the topic, if someone inherits an IRA, if you don't spend all that money out of the IRA from our RMDs, there's money left over and it gets passed on to a non-spouse. Now there's only a 10-year period of time that they have to take that money out. They can no longer stretch it over their lifetime. They have to have it all out by the end of the 10th year. So they're really cracking down on generational wealth transfer. We want to make sure that we plan for you to make sure that doesn't happen to you. And again, another thing you can do with the RMDs is to fund a tax-free legacy or an asset-based long-term care policy. You obviously have to qualify for life insurance in order to do that. Although we do have a few guaranteed issued type products, but they're not going to pay out the same types of benefits. So let's see if we have any questions. I know Shane has been fielding some questions over here. Does anyone else have any other questions about required minimum distributions and how they work? Feel free to type it into the chat box there, and we will answer it. Hopefully this has been informative. If this applies to you, if you have any questions about your situation, if you're having to take RMDs in the future, or if you want to plan ahead so you can maybe reduce your taxes on required minimum distributions, please reach out to us. We can plan for you and set up a way for you to possibly reduce some of the impact of the required minimum distributions and those taxes. So I hope this has been informative, and I hope to see you guys in person sometime soon at these events that I've mentioned earlier in the presentation. And I hope everyone has a great rest of your week. Take care. Bye-bye.